Hello, Maverick traders. Welcome out to your market roundup for September 6th, 2022. Corey here with you. Make sure you follow your trading plan. So the markets are kind of interesting. We had the markets closed yesterday for Labor Day holiday here in the US. They reopened on Tuesday and for the most part relatively quiet, kind of a sideways to lower day. We did bounce back a little bit at the end of the day, but not too much going on. I mean, down 0.5% across the board, a little bit worse than that in the NASDAQ and the Russell 2000, which were each down close to 1%. Oil and gold relatively flat. So a little bit of a quiet day coming back from the holiday. Advanced decline line, you can see about 70% of stocks, about 7 out of 10 going down. And the 50-day moving average has certainly flipped with more below the 50 MA than above at about a 3-to-1 ratio on that. So we're in this kind of bearish market environment. We talked about the big picture. I still think we're in a bear market. I really emphasized that point a couple of weeks ago because I didn't want this rolling over to kind of be a shock and a surprise. That's how corrections work. But more than that, I wonder if we're in a sideways market. And I'm going to try to paint a little bit of a picture, kind of here's what I expect, here's what I anticipate, and we'll go through that together. On the news front today, Apple iPhone 14 event kicks off on Wednesday. There is some truth to as Apple goes, so goes the market. So if Apple is collapsing to the downside, the stock market's not going to hold up. If Apple zooms higher, on a big trend, the market's probably going up as well. It just such a huge weighting in all of these indexes and ETFs and such. But does that mean that tomorrow kicks that off? Not necessarily. A lot of times these are bigger on the smoke than the actual fire. So we'll see. Russia cuts off gas supplies to Europe. There's already worry that Europe's not going to have enough, and Russia is further fueling that problem. And this is part of the issue with tying your economic future to Russia, and now that has not been a good decision for Germany and the European Union in general. And their reliance upon Russian energy, I mean natural gas to heat during this winter time period, is a real problem. It's a real issue. Europe's already in economic recession, and we've got some issues there. Now, this is widely known. We've certainly been talking about it for some time. We've been highlighting EQT, the largest nat gas producer here in the US, LNG, which ships out liquefied natural gas, can actually ship that to other countries. There's some business opportunities for that, but this is one where maybe that's kind of getting fully priced in. It's been out there, it's been known, and the markets have had ample opportunity to adjust accordingly. So I talked about drawing up a map and kind of expectations. So what do we think the market's going to do here? Well, we're at kind of the last line of defense. If you were to take from this low in June to this high and measure it out, for those of you that use Fibonacci retracements, here was about a 38% retracement. Here's about a 50%. Here's about a 61.8. That's a key level. So this is your Fibonacci zone. This is the zone that it kind of has to hold in order to hold up and to have any sort of substantive continuation to the upside. And we're at that last line of defense, the 61.8% retracement level, or the bottom of that Fibonacci box is right here, right now at about 390. We bounced at the end of the day. You could make an argument that we're kind of in this little bottoming out, call it an inverse head and shoulders or whatnot. But I think the pattern that I see is ultimately, I think we bounce here for multiple reasons. And one of those is we're also on this trend line. If you were to draw a trend line off of those lows, guess where they intersect? Right here with this low. So we're exactly where we should have gone to, and this is exactly where we should bounce. And oh, by the way, I also think the top of the range is over here. And I've touched on this recently that my expectation is that we're in a trading range, that we're going to stay in these same general price levels for the coming weeks. Now, I could be wrong about that, and we could have a big breakdown, but the next couple of days will be very telling as to whether that pattern plays out. And what should happen is a little bounce, and then it kind of pulls back, and then another bounce that has a little more, speed to it and aggressiveness to it that kind of takes us back here into the low 400s on SPY, and a good little rally here that the markets can have over the next couple of weeks. So that doesn't make me really bullish big picture. I still think we're in a bear market, but we're in a consolidating way. You can kind of see that in the moving averages. The 20s rolled down, but the 50 is still kind of sloping up. There's just a lot of mixed signals, and that usually speaks more to this type of price action than this or this, right? We're just in a tug of war right now. That's how I see it. The NASDAQ, same thing. We bounced right at that 61.8% retracement. I would expect that we'll get a continued bounce and that ultimately you're kind of in this, triangular trading range, if you will. Now, as we look at the heat map, there's not a huge differentiation, nothing that stands out too much other than real estate clearly more in the green. Energy is definitely in the red, and then just, communication services, technology, I would say more in the red as well. Consumer defensive, even more in the red. But, this is kind of what a sideways day is it kind of looks like a mixed bag. There were a couple of sectors that were better, a couple of sectors that were worse, but for the most part, kind of in that range. Now, longer term outlook, I would be, still over here, still in the -1, -2, -3 on a long term basis, but everything kind of runs its course on over different time periods. And in the short run, I would expect a bounce back for a week or two. I would expect some sort of rally before ultimately we probably go back and break those levels. So time will tell, but right here, right now is where we should bounce. Now, I talked about this on Thursday. We've only really had, I guess this is our second trading day since I did the market roundup. I don't usually do them on Thursdays, but I kind of talked about this same outlook is that, hey, we're getting to the levels we should bounce. And so in the short run, some of these bullish trades look kind of interesting. Now, let's take a look at GE as the first chart. You're back to the 50-period moving average. Couple of things about this. This one didn't pull back as hard, so this is not back to the 61.8. And still bullish, kind of that high and pulled back. The pullback is kind of your standard 1, 2, 3 or ABC type of pullback. And the preceding rally was sharp and strong, a multitude of bullish candles on increasing volume. The pullback has been on lighter, declining volumes. I mean, it's all the characteristics you like to see where the volume's higher on the way up and lighter on the way down. GE should rally from this level here, especially in a market that bounces back. I continue to talk about Oxy, and I did take some profits on this one, by the way. We went back up to that resistance zone, and I just got into a trade today down here at about 67, re-entering Oxy. I've traded this stock really well. I've put on a multitude of bullish trades. Every one of them has been profitable, knock on wood. I say that in terms of something that I always emphasize to my traders. You want to do more of what's working and less of what's not. You want to focus your attention on the good things. Don't get caught up in revenge trading. Find the areas, find the sectors, find the stocks that you're trading well, and continue to focus on them. Part of this outlook, homework assignment, I've done this before, I'm doing it again today. Go pull up a 10 or 15-year chart on Oxy and count the number of times that it failed at this resistance zone. Ultimately, I do think we're going up and through there. So I'm going to continue to look for times to take profits when we get a little overdone, times to reinitiate, which I actually did today, right down here at about these levels. And some might say, well, you're not really waiting on confirmation. You're not waiting for it to turn back up. That's true. This is one that will have news, and I think the news is going to come out. See, Berkshire Hathaway continues to buy when this stock's in the 60s. And now that they have a larger than 20% position, actually, they have to report daily. Once they have over 10% of the stock, they'll have to report their purchases, and more purchases are coming probably today. So I think that should cause a little bit of a gap up tomorrow in the stock. And if I'm right about that, today's entry was pretty good. Now, if we gap down, well, bad on me for not waiting for more confirmation, but there was a specific reason why I re-entered this trade today down at these levels, and that's also the prior breakout point. So, at some point, will it stop going up? Yeah, at some point. I mean, trends stop. I stopped trading it to the upside for a period back in here, but I'm trading it bullish again. It started to redo that over in here, and we'll continue to do so as long as it's working. UPS is the last one on our bullish list. I've had this one out there since Thursday. We put it on, and today's chart really didn't change that. I haven't entered this one yet, but certainly today's setup and candle looks even better. And I like that FedEx was downgraded, yet UPS turned all the way back to flat on the day. The sellers tried to push down and the buyers came in aggressively. I really like UPS to trade higher from here as well. And then on the bearish side, let's look at AbbVie. This one more technical than anything else. You have come back to this support level. You kind of have a little mini, inverse cup and handle. The chart pattern where you have a key level, you bounce on it initially, and then ultimately it fails. And that's what I would expect out of AbbVie, is more downside. For one reason or another, it's been trending much worse than the majority of stocks and markets out there. Dollar General, I also have a bearish outlook on this one. A little short-term bearish crossover here in the moving averages. Some failure on the part of this stock to hold up here where it could have been bullish. It could have been bullish up here, and when that chart pattern didn't hold, this was a big turning point where it started to break down there. That breakdown leads me to believe that there's more selling coming. So Dollar General as a potential bearish candidate, a move down there to 230, 225, something in that area seems likely. And then last but not least, GameStop. And I've had this one up on the bearish list for a little time. Whether it's GameStop you're trading or AMC or what are some of the other memes? Bed Bath & Beyond has been in the news. Bed Bath & Beyond, the news was the CFO actually looks like he committed suicide over the weekend. I mean, these meme stocks, they're getting a lot of attention and not for the right reasons. Ryan Cohen is under investigation for various things. He has been one of the people that has profited most from all of the, I don't know if you'd call them shenanigans or whatever it is that drives these meme stocks. He's right in the thick of it. There's rumors and speculation and even lawsuits that he was working with the CFO of Bed Bath & Beyond to pump and dump their stock and so on. Now, innocent until proven guilty certainly applies here, but these meme stocks, they're more importantly just to us is not what you believe or don't believe about those stories. It's more about what the market believes and whether these companies can trade on their own without widespread support from the general public, and whether the public is going to continue to do this with all of these allegations circulating and so on. And I don't think it will. And I think that's why this chart is breaking down. Now, there will be some violent rallies, but ultimately in the coming weeks, months, and even years ahead, I would think that all three of those stocks are going to continue to work their way lower over time. GameStop is probably headed closer to $10 per share than from its $25 share price. That sort of thing would be my expectation, big picture. So markets are still in this bear market. Likely to bounce in the short term, still in this trading range in the near term. Fed Chair Powell speaks on Thursday. Earnings reports, we've got DocuSign, which has had some huge gaps. It had a almost 50% gap down a year or so ago. GameStop reports on Wednesday. I just talked about this one. Ideally, what I would love to see is a rally on those earnings and then another opportunity to get short. Kroger, Zscaler, and so on, Asana, all of these companies that report, pay attention to those, and especially GameStop is going to have some volatility on its earnings. I hope you enjoyed this market roundup. Have a great rest of your day, and we will see you next time. Goodbye, everyone.